Well, hello, hello, hello. Welcome back to the Productpreneur Success podcast. And this week's episode, I think, might be a little bit of a hot topic. So I'm really keen to dive in and also keen to hear what you think after you've listened to it. Now, recently, I've been seeing a lot of e-commerce brands, either shutting down or trying to sell, as well as many who are just not making enough money and really working hard to turn that around. Hands up if you've been in that situation or if you are right now. I think part of this situation stems from the many online stores that, started up during the COVID years where lots of people were working from home or needing to replace regular work with some other means of generating an income. And of course, during the first couple of years of COVID, e-commerce retail sales absolutely boomed. It was like many years worth of growth in the e-commerce sales over just like an 18-month period. It was almost as simple as, opening an online store and you'd make money without really needing to master the art of, marketing online or selling online and I guess learning the ropes of how to generate growth online. And 2022 started to see some challenges hitting the e-commerce industry with supply chain delays, increases in the cost of shipping, of course, now inflation and interest rate rises, constricting consumer spending power and all of that fun stuff. Not to mention the impact of the Apple iOS update and, that made online advertising a lot harder for many people to achieve profitable results. Anywho, enough of that doom and gloom. All of a sudden, of course, though, e-commerce businesses have had to work harder with their marketing in order to achieve the same level of revenue and, trying to learn how to do it in a more clever way so that they can actually still be profitable with it because, typically the way a lot of stores used to advertise and things like that just are more expensive now. So and also, I just think that many who started during that COVID boom time might feel just a little bit like they're failing or not cut out for this kind of business just because it's so hard now, when in reality, it's actually normal to need to work at this stuff. Another reason I think that many brands are struggling comes down to cash flow management, or perhaps a lack thereof, as the case may be. And as the saying goes, revenue is vanity, profit is sanity, but cash is king or queen in my world, of course. And so if you're working your tail off and, generating revenue, but not really seeing anything left in the bank account at the end of each month, or perhaps struggling to, when you've been hit with a GST bill you weren't expecting or prepared for, the important thing is to first not panic. And secondly, know that pretty much everyone struggles with this at some stage in their business. It does not mean that you or your business are, failing, or, it doesn't mean that your business isn't going to work, excuse me. And it does mean that, you just need to learn some new skills so that you can get on top of your cash flow situation and really start making and keeping more profit for yourself. Now, in this episode, I am going to be sharing some really simple practical strategies to help you master your cash flow management. But before we get to that, I want to share a few statistics and stories. Now, first of all, did you know that 1 in 5 e-commerce businesses fails within 1 year, and that rises to 30% in the second year, 39% in the third year, and well over 40% in the fourth year, which is quite sobering. And just recently, there was a story in the Aussie news about online furniture retailer Brosa, who went bust with something like $24 million in debts, including $10 million that were in customer orders that hadn't been fulfilled, and only $4.3 million in assets. And it's been a little bit of a common scenario recently. Fashion brand Alice McCall was a similar story, as well as Ballistic Beers in Queensland. I don't know if you've heard that one. There's been a few. And Brosa was one brand that had enjoyed massive growth during COVID lockdown periods, as lots of people were spending so much more time at home and undertaking home improvements like buying new furniture and all of that kind of stuff. All three brands, though, found themselves in a position where they were spending too much money on fixed overheads, and they didn't have the cash reserves to weather any kind of sales downturn, and ultimately couldn't pivot quickly enough to resolve that situation. Another example of this is the recent collapse of Deliveroo in Australia, and where the reality was that their overheads and expenses were always more than their revenue. Now, normally this is to be expected when you are starting up a business, and you'd usually expect to get to a break-even point beyond which your revenue exceeds your overheads and you start making a profit. But in the case of Deliveroo, their expenses were not all fixed like that, and their expenses were scaling up at the same time as revenue. So even when they made more money, they spent even more than that. So it was always a loss-making business and only surviving on investors stumping up cash, which is not really, the smartest thing at the end of the day. Well, I suppose if you were one of those early investors, you probably made some good money, but too bad for the last ones, I guess. Anywho, smaller businesses, though, the issue often isn't spending too much on fixed overheads, particularly those of us in e-commerce. More often, I see that, things like, they haven't priced things correctly, or they don't understand their cost of sales, or they have, or have a clear handle on their marketing and advertising, or really just having the practical strategies in place to manage their cash flow. So it ends up in a situation where the business owner sees the money coming through the till and makes decisions on whether they can afford something based on what they're seeing in the bank account, without realizing that, they need to deduct GST and shipping costs and cost of goods and advertising and so on before they calculate what they actually have to spend. There's this Parkinson's law of money. Don't know if you've heard of that, but it suggests that no matter how much our income increases, we have a natural tendency to spend the entire amount, and often in the world of easy credit options, somewhat more each month. And I've seen examples of small business owners wanting to match revenue with expenses, usually trying to claim as many home office expenses as possible so that they can personally benefit from the business, and totally get that, right? But their goal there is, to not have to pay any company tax bills, but that's quite a risky way to run. It really only takes one bad month and you're in the red. And so the reality is poor cash flow management, running out of cash, or other cost-related issues, they're contributing to all of these sorts of business failures. But it doesn't matter at the end of the day how much you make. What you keep at the end of the day is really what matters most. Now, before we do dive into these cash flow management strategies, I want to share some other contributing factors to business failures. And these aren't my imaginings. This is according to David Koch, good old Koshy. And so apparently there are 5 big reasons why e-commerce businesses, specifically that business model, fail. And firstly, it's not planning. And, so really what he's getting at here is the brands that are meandering along and kind of, I don't know, holding up a finger to the breeze to make decisions about what to do next may seem, superficially successful, but they're often the ones that crumble when things get a little unexpected or chaotic or difficult, because they don't have a plan that lays out exactly how they'll achieve their goals. They usually aren't therefore measuring their progress, and no doubt, the fact that they don't have a plan probably also means they don't have any documented rules of operation that are guiding their spending decisions. So they spend money just chasing shiny objects or silver bullets that never ever works. Secondly, pricing errors, and I see this a lot too. Too many brands price their products too low, and they're telling themselves maybe that they don't want customers to think that they're a rip-off. They don't, they want to be high quality but affordable, but they leave themselves without enough margin to operate, and with margins that lean, rather, they're kind of skating a really thin line between break even and making a loss, and that's pretty risky as well. So those two things definitely relate to, making profit and keeping profit and cash flow management, right? Thirdly, Kosh is listing starting before you're ready as an issue that can cause businesses to go under. And I guess that is a common thing for many people to do that and to try and fail fast, as the saying goes. But I have this feeling that most of my audience are probably not that type of person. I think many of you are the type A perfectionists and rather delaying things until you have it perfect before hitting the go button. However, I do agree with Koshi that it is important to make sure you have market demand for your product and you know how you're going to differentiate and stand out from the competition. Because if you're basically copying another brand, either in terms of product or the brand look and feel, you're probably going to be in for a rough time. Now, the fourth reason that Koshi lists as a common reason for failure is relying just on paid ads for your traffic. And so, of course, this also relates to cash flow and keeping profit. And this is because paid digital advertising costs more. Like basically it just costs more. The CPMs, the cost per million impressions, costs more than it did when Facebook was a shiny new thing. There's just no way to get around it. In fact, it's not just Facebook, any of the digital advertising channels, it's the same thing. In the early days, it was really simple to put a dollar into advertising and get $10 back. You didn't really have to try very hard. But of course, there's a whole lot more competition for ad space on these platforms, and various other things like Apple iOS's 14.5 update. But there's a variety of reasons why ads have become more expensive, and getting those kinds of returns on cold traffic is basically impossible. So really it's pretty hard to be profitable to scale a business from paid advertising alone or paid traffic alone. Now, you guys probably know in my books, it's always risky to just rely on one channel anyway, particularly if it's a channel that you really have no control over, like social media or Google or anything like that. Which is not to say you shouldn't advertise there. Of course, you absolutely should. Just don't make it your only marketing channel or you'll go broke. And so the fifth reason Koshi lists as a common reason for failure is confusing the brake with the accelerator. So as he describes, just because you might be able to find the timing belt in your car, it doesn't mean that you should try and change it yourself. And similarly, e-commerce is a trade and it's not a super simple one, right? So success in this kind of business model is the sum of all parts: operations, logistics, customer service, marketing, product, pricing, and everything else as well. So you need to take the time to learn the trade. And if you can't tell me what AOV, CVR, and bounce rate are, then hint, average order value, conversion rate, and bounce rate. So if you can't really tell me what those mean, then it's back to the drawing board, or of course, come and learn from me and my team, as this is the stuff we teach. Anyhow, before becoming another statistic, it really is worth remembering that e-commerce can be a really, really lucrative space. At the moment, it's only accounting for around 20% of total retail sales in Australia. And it's growing. However, it can be a tricky beast. So before you dive into an expensive website or filling your shipping container worth of product, it is worth taking the time to learn the basics and grow your knowledge and skills before trying to grow your business. So, lots to do here about pricing, about profit, revenue, cash flow management, all of these kind of things, so crucial to being able to succeed in e-commerce. So let's discuss 3 practical cash flow management strategies that are going to help you get back on track if you're in the red, or keep you on track if you are in the black, and help you stay there as you scale and grow your business. So we're going to all try and become cash flow queens. So the first thing that we need to address is your pricing. Part of pricing comes down to strategy. For those of you who studied marketing at uni, you'd remember that price is one of the 4 Ps of a marketing strategy. I have observed over many, many years, too many women in particular, I don't know why, price their products too low. And so I don't know if there's like a mindset around not wanting to charge too much for fear of customers choosing to buy elsewhere, or fear of customers feeling ripped off, or even, maybe there's a fear that you'd be seen to be greedy to add too much margin on top of your cost of goods. Whatever the reason, I've seen many instances where a brand owner believes they're offering high quality products at a low affordable price. The problem, for starters, is that as consumers, we don't correlate low price with high quality. So, think about it. If you go to the supermarket and you look at a $2 home brand block of chocolate versus a $10 block of cocoa black chocolate, even without that brand name on there, you'd probably assume that the more expensive item will have higher quality ingredients and taste better. But from a cash flow perspective, you also need to price things with sufficient margin to fund the operations and marketing required to run and grow your business. Now, a couple of years ago, I want to tell you this story. I was talking to a prospective client who was wanting some help with advertising so she could get more traffic and sales to her online store. Pretty common scenario, right? And so she had a brand of fashion accessories for women, and she'd gotten the business off the ground quite successfully and grown the sales revenue quite quickly to around six-figure a year mark, but had hit the bottleneck where she just did not have enough time to do more. You know, she literally could not keep growing her business because she didn't have enough time in the day, so she really needed to get some help if she wanted to keep growing. But the issue, as we quickly found out, was that her margins on her products were too slim. The minute she either added in another salary or the cost of more advertising, she was going to lose money. And this is unfortunately a common mistake. So you need to work your pricing out so that your cost of sales accounts for not just the cost of the product itself, which of course should cover the item and packaging and really the freight to get it delivered to your warehouse. But your cost of sales should also cover any other costs that are going to increase as your sales revenue increases. So this might include transaction fees, and it should definitely include your digital advertising costs as well. It might also even cover at least some of shipping fees to customers to send customer orders out, because many people are wanting to use incentives like free shipping as part of their marketing strategy. Now, why do I want you to include something like advertising costs, digital advertising costs, as part of your cost of sales? Now, I realize some old school accountants are probably going to disagree with me about that in this instance, but the reality is that, without traffic to your online store, nothing else happens, right? If you had a physical retail store, part of the cost of your rent is going to be the location, the benefit of being in a location where there's a lot of foot traffic. But on your online store, without traffic, nothing happens, right? You certainly aren't going to make any money. And digital advertising is, or should always be, your most scalable source of traffic. It should never be your only source of traffic, of course, but it is going to be your most scalable source. And without it, you're really, really going to struggle to scale and grow an e-commerce business. The other thing I want to add to my cost of goods is some margin to cover your fixed overheads. So what do I mean by that? Because, that's a bit of a duh comment, I realize. But too many brand owners price their products by literally taking that cost to produce the item and then adding in the profit margin that they want to make. And that's kind of called a cost plus pricing strategy. So let's say you're in the candle making business and you've got the cost of a jar, the wick, the wax, the label, and it all comes to $10. Now, I have no idea if that's even in the ballpark of the cost to produce a candle. Totally pulled that round figure from my bum. But, for the sake of argument, let's say it costs $10 to make one finished candle. Then they take the price and maybe double it to get to their retail price. So they have a gross 50% profit margin. So that sounds like it'll be enough, right? Pretty good margin. But unfortunately, it often isn't, because they haven't factored in their fixed overheads, costs like website hosting, payment processing fees, rent, postage, wages, and so on. Nor have they factored in the other cost of sales like digital advertising into that cost before adding their margin on top. And frequently, they also haven't realized that the recommended retail price they sell the product for includes GST. And, that they then owe the government. Not to mention, the minute you turn a profit in your business, you also have to pay income tax. So that gross profit margin can quickly get eaten away if you aren't factoring all of these things in properly. Another pricing strategy I see brands use a lot is, well, let's see what all the other brands on the market are retailing for and we'll match it or even beat it. And the assumption there is, of course, that consumers aren't willing to pay more for a comparable product. Often when people use this pricing strategy, they actually haven't done the sums to work out any of the margins or costs that I just mentioned. And of course, right now, I definitely have been speaking to a lot of brand owners who have not put their prices up in the last couple of years when costs have definitely increased. And so they're really, all of that is eating into their margins. And, you only have to open news.com.au and you'll see Coles and Woolies, they're raking it in, that they're not letting themselves suffer on their net profit margin. So, so I guess hopefully what you can see is how quickly and easily a poorly priced or underpriced product can lead you into cash flow issues as you grow. The second cash flow management strategy that you really need to work on is your break-even analysis. So basically this means how much do you need to sell at that price in order to cover your fixed overheads. And if you do a quick Google search, there's a really good blog about this on the Shopify blog, and it has a link to a free Google Sheet calendar tool, calculator tool that you can download and use. And the key here is to make sure that you have accounted for your scalable paid traffic costs as a cost of sale, and made sure you've priced your products correctly with enough margin to cover, all of those things like digital advertising, because advertising is not a fixed overhead, it's a variable one. You'll spend more on ads to make more revenue, right? And of course, the reason I bring this up is because so many small business owners hold back on spending money on advertising because they look at their bottom line and they see that they're not making any profit yet at the end of the day. And of course, if they haven't priced correctly, they may not make any money at the end of the day, much like the story of Deliveroo's business failure that I mentioned earlier, where every time they made more money, they spent and lost even more money. But where you've priced correctly with margins to cover something like digital advertising costs as a cost of sale, then you are only looking at your fixed overheads in that break-even analysis. So then you can do some sums to figure out how much revenue you need to make in order to break even and cover all of your fixed costs, so that beyond that, you know that you're going to be making a profit. And I find that once you understand this, and you understand that until you pass that break-even point, your profit and loss reports will probably be showing that you're in the red, usually you have a lot more confidence to work hard and fast to reach and then surpass that break-even point, and to obviously then start growing and making and keeping more money. Now, the final cash flow management strategy that is really practical on a day-to-day basis is pretty simple, really, and it's literally opening different bank accounts to put money aside every week. So for me, I just want to walk you through what I have. It sounds like a lot of accounts, but it's pretty simple to manage, really, especially if you're using something like Xero for all of your bank reconciliation. So for me, I have an account that is like a daily transaction account, and all of my revenue gets paid into that account. And from there, I'm divvying it up on a weekly basis. So I'm putting money into another transaction account to fund all of the overheads and expenses. So I call that one my OPEX account. I put money aside into a higher interest account to save up for super and BAS and tax. I put money in another high interest account to fund the cost of goods. And then I'm putting money aside in a high interest account where I set aside profits. So this is the next profit, the net profit rather, that I've calculated that I should make based off that break-even analysis, and also the profit and loss projections that I've done for the coming year. And then finally, I'm putting money aside in a high interest account I've affectionately named War Chest. And this is like your rainy day fund in case the shit hits the fan and you need to cover running costs at a time that maybe revenue is impacted, such as by a natural disaster. And then finally, when it comes to setting aside funds for cost of goods, if you are someone who manufactures in bulk and your production bills are really large, you need to be careful about putting aside enough to cover what you've sold plus enough to cover your growth rate. So for example, if you're aiming to grow by 20%, you'll need 20% more stock to sell. So you need to be making sure that you're putting funds aside to cover those bigger production costs. Now, does it all work out so neatly, every day, every week? Sadly, usually not. That would probably not be real life. Sometimes, we all need to use a credit card or an overdraft facility just to plug the gaps whilst, it's not like most businesses have a set amount of money coming in every single day. So, but what I know for sure is that, by doing it this way and using the multiple account strategy, is that we make better decisions, better financial and spending decisions by doing it this way, because our money is divided into these different accounts, or you can call them buckets, I don't care. It makes it much clearer whether there is spare money to spend on that shiny object or silver bullet that you've been attracted to. And B, we keep more money, more profit over time by managing our money like this. It's because of that Parkinson's law of money that I mentioned earlier. Now, after all of that, you might be wondering how to figure all of this out for yourself. And it is quite personal depending on what sort of product that you sell, what your business model is, whether it's pure e-commerce or if it's wholesale as well, what your goals are, and so much more. And this is, working out all of those specific figures and percentages and pricing strategies and all of that kind of stuff. This is all the kind of stuff that I help our mastery clients to figure out. And also, of course, how to make more money with your marketing strategies and your growth strategies. And then, of course, how to keep more of it as well, which is way more fun. Now, it is pretty hard to do all of that for ourselves, especially if you've never done it before and you don't know. So this is really where it can help to work with a coach that can guide you through it. So if you're, keen or interested to investigate what that might look like, then, definitely give us a shout. We do have some places available to work with me and with us. So if you're curious to explore what that might look like and see if we're a good fit to work together, make sure you book in for your free brand growth strategy session. And you can do that by clicking the link in the podcast show notes page, or just head to catherinelangman.com/work-with-me, and you can schedule that in. And of course, like I said, I'll be sure to share that link on the podcast show notes page. But for now, that does bring us to the end of the episode. I hope you've enjoyed this one. And like I said at the start, I'd love to hear what you think about this one. It's a little bit of a different episode. But I hope you guys all have a fabulous rest of the day, fabulous rest of the week. And I really look forward to being with you again on the show next week. Bye for now.